how can long-term investors respond when certain areas of the stock market are trading at extremes? Today we're going to be looking at the S&P 500 in particular and comparing it to other parts of the world because currently there are certain areas that are trading at extreme valuations. We're going to talk about what we mean by extreme. We're going to look back over the last 30 or so years of history, and we're going to talk about the implications for long-term investors and how they can think about their portfolio. Okay, let's get started. This chart here goes back to 1995, so we have roughly 30 years worth of data here. Now, this is comparing a relative valuation, so in other words, how expensive and cheap two assets are compared to one another. Okay, now this is comparing USA large cap growth, which is another way of saying kind of like the S&P 500, and it's comparing it to, now this is a mouthful, the global ex-US small value, which means smaller, less expensive companies from around the world. Now, as you can see, going back to 1995, it's trading at like, let's call it a 1. So from a relative valuation standpoint, they're trading at about the same valuation. Now, then you see the line start to drop pretty dramatically. What does that mean? Well, what it means is the large cap growth, and I'm just gonna supplement that with the S&P 500. The S&P 500 is getting more expensive relative to these companies from around the world. Now, this continues to happen from the early 90s to about 99 or 2000. Okay, you see that line just start to drop. And when it hits the bottom, what does that mean? Well, that's an extreme valuation comparing these two asset classes, which is the S&P 500 versus small companies from around the world. The S&P 500 is trading at an extreme relative valuation, which means it is way more expensive than the rest of these companies around the world. Well, if we're looking at 99 to 2000, what did the S&P 500 do for the next decade or so? Well, you see the line start to go up. Now, what the line going up means is that the S&P 500 starting to get less expensive relative to the rest of the world. Now, you weren't looking at this chart if you were looking at your statement. If you own the S&P 500 during this time, you just saw the S&P 500 do poorly for about 10 years. So the rest of the world did just fine. The S&P 500 did poorly, so you see that chart start to go up. So that is the S&P 500 underperforming or essentially returning zero for about 10 years, okay? Now, where are we today? Because I talked about, hey, we're back in extreme valuations or extreme relative valuations. Where are we today? Well, at this chart, what you can see is this line is now bouncing around the bottom, which means the S&P 500 is at an extreme level relative to the rest of these smaller companies around the world in terms of being expensive. Now, what does this mean for long-term investors? Okay, S&P 500 or large cap growth is expensive. What does that mean? Well, you can still own the S&P 500 or large cap growth or own whatever you want as long as you know what has happened in the past when certain assets get expensive at extreme levels relative to other asset classes. Okay? And so you might look at the S&P 500 or large cap growth and say, this is all I'm going to own forever, right? And here's my reason why. And as long as you have a compelling reason why, you know what you own, you know why you own it, as I've said in all my videos, then that is absolutely fine. What we found is a lot of people don't know what they own. They don't know why they own it. It's just pieces of the portfolio. And so in particular, when the market is trading at these kind of extremes, where one is extremely expensive, which means the rest of these companies around the world are actually quite cheap. And the less you pay for future cash flows, the higher your expected rate of return. And as long-term investors, our goal is to get a rate of return that compensates us for the risk that we take. And so we're buying future cash flows of companies. The lower you can pay for those cash flows, the better you are. And so anytime you hear words like extreme, in particular relative valuations, if you want to own the extremely expensive ones, just have a compelling reason why. And going back to, as I always say, know what you own and know why you own it. I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.